Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney will visit China next week as his government tries to rebuild the relationship and reduce Canada's economic reliance on the U.S. Carney is set to meet with Chinese President Xi Jinping with discussions focusing on trade, energy, agriculture, and international security. The trip marks the first by a Canadian Prime Minister in more than 8 years. U.S. President Donald Trump saying Venezuela will send up to 50 million barrels of oil to the U.S. at the current market price. That would be about $2.8 billion. Trump says the move will benefit both countries. This comes as a blow to China, which was previously a top buyer of Venezuelan oil. Venezuela has a backlog of unshipped crude since the U.S. blockade of sanctioned oil tankers was announced last month. Home sales across Toronto saw a decline in December, along with the average selling price. Data from the Toronto Real Estate Board shows sales fell 0.4% versus the month before. The price of a home fell 5% annually, and sales were off by more than 11% as buyers failed to return to the market despite lower interest rates and more listings. The board says economic uncertainty weighed on the housing market throughout the year. And taking a quick peek at the markets right now, you can see the TSX is now giving back after the rally to start the year. It's off by nearly a percentage point right now. And south of the border, U.S. markets, mixed bag, depending on where you look. You can see the S&P 500 up ever so slightly, 0.1%. Dow Jones off by 0.35 after pushing up close to 50,000. And the NASDAQ is up 0.47%. Outside of tech, the strongest demand environment right now is aerospace and defense. That, according to our next guest, who will tell us more on his expectations for the market for this year. We're joined by Jed Ellerbrook, portfolio manager at Argent Capital Management. Thank you, Jed, for joining us.
Hey, good morning.
Let's talk about just overview for what you're expecting for 2026. What are you seeing?
Yeah, I think your lead-in comment was right. So obviously, AI infrastructure demand is exceptionally strong. That's what's driving the U.S. stock, the U.S. Economy, North American economy. But another exceptional area of demand is aerospace and defense in both parts, including aerospace, commercial aircraft, both new deliveries as Boeing ramps up. Also, the commercial aftermarket is very strong as airlines have run those planes really hard the last few years and ran them longer, more years than they typically do. So the average fleet age has grown, which requires more repairs, more aftermarket activity. And then the other side of it, defense, demand is exceptionally strong too. The U.S. defense budget is growing at a double-digit rate. I expect it will continue to grow. The U.S. military has been a little bit more active here, over the last year overseas, and so both aerospace and defense demand are exceptionally strong. TransDigm is our favorite in that area. We also like HEICO, which is a bit smaller company. Both those companies are growing, double digits today, and we expect they'll complete acquisitions to enhance that growth as well.
And what are you liking about TransDigm?
Yeah, TransDigm, new CEO, promoted internally through the company. This is, the prior CEO led the company for about 10 years, did an exceptionally good job. He came from Precision Castparts, which is owned by Berkshire Hathaway. I think it's a very well-managed company, very well-managed succession. I think the new guy is going to do a nice job. He did his first sizable acquisition about a week ago. Good to see that the company still has M&A options available, even though they're much bigger now than they were several years ago. So I just like that combination of organic growth as demand grows from their customer base, enhanced by acquisitions, and any money that's left over is typically returned to shareholders via special dividends in the fall or winter. We saw one of those 3 or 4 months ago.
And what kind of a return was it?
I believe it was 4 or 5% of the market cap.
So a nice number there. And they really have their I want to say their fingers and everything, but most companies need them, don't they?
Yeah. So TransDime's value proposition is they try to acquire and they try to grow product lines where they are either the sole source or just two sources of that product. Oftentimes, those products are spec'd into the FAA requirements for those aircraft or helicopters. And so, recurring demand, limited competition, that enables pricing power for TransDime year after year to increase their revenues and profits.
And forgive me, what was the second company you mentioned that you're liking right now?
Yeah, HEICO, ticker HEI.
And what about that? What do you like about that one?
Yeah. Similar story. The little twist with HEICO is they have a PMA business, which is like a kind of like the generic food option for the aerospace industry. They offer alternative, cheaper parts for certain aircraft repairs, and that business is growing well because airlines are price sensitive.
Okay, and then let's just go into the one that everybody's talked about, AI and hyperscalers. Let's get your thoughts on that. Where are you standing with that?
Yeah, exceptional demand growth year over year for accelerated compute in data centers. NVIDIA, of course, is a really large beneficiary of that, but that trade broadened out really dramatically over 2025. I think the memory component companies have done exceptionally well lately. Micron is one of the bigger ones there. SanDisk is another. We've also seen Broadcom and Marvell, who are kind of custom chip developers, doing well, supplying chips to companies like Amazon and Microsoft, Google, that want to develop their own in-house option that's a little bit cheaper. And then also the semi-cap equipment companies. Applied Materials is one that we own in ticker ABIG, which is our ETF. Applied Materials makes the equipment that's used to fabricate semiconductors in TSMC's plants over in Taiwan and other places around the globe. So the trade has really broadened out this year. I think this is a rising tide lifts nearly all boats situation. And I think all those companies will continue to grow rapidly in the coming years.
And no concern about CapEx right now?
Yeah, two big investor concerns are, number one, how are customers going to finance the purchase of all this equipment going in data centers? And then, number two, is customer demand actually going to arrive? Are these new use cases going to actually enter the real world? Is robotics, going to proliferate across supply chains? And I think the answer to both is yes, those hurdles will be overcome. I think capital markets remain fairly friendly to AI data center construction, and customer demand is there. And we are going to see all that affirmed, I think, this first quarter earnings season in 2 or 3 weeks. We're going to see the big hyperscalers, Google, Microsoft, Amazon, Meta. They're going to tell us demand is exceptionally strong for these new AI tools. The compute capacity is put to work immediately when it's turned on in a new data center, and they're going to build more.
Okay, and I just want to sneak in one last question about the alternative asset managers. Some people like to shy away from it, but you're not one of them.
Yeah. Well, first of all, those stocks are down this morning. There have been a couple banking downgrades here over the last couple days. So I think this is a buying opportunity in those businesses. We own Blackstone and Apollo and Hamilton Lane, as well as Carlyle. We think the whole space is attractive today. It's growing because capital markets, like I said, are friendly. GDP growth is strong. Interest rates are coming down. M&A activity is rising. IPO activity is rising. So this is really a very favorable environment for these alternative investment managers. We think fundraising will be strong. I think investment returns are going to be strong, and markets are supportive.
Okay, we'll wrap it up there, Jed. Thank you for joining us.
Have a great day.
Jed Ellerbrook is portfolio manager at Argent Capital Management. Well, recent developments in Venezuela are raising questions about the global oil industry and how they might impact Canadian crude. We'll have more on that right after the break. After U.S. President Donald Trump vowed to rebuild Venezuela's energy sector, many are calling for Canada to ramp up its energy exports. CTV's Rachel Aiello has more.
The Prime Minister is facing new pressure to ensure Canadian oil remains competitive in light of U.S. President Donald Trump pledging to rebuild Venezuela's energy sector.
we're going to take back the oil that, frankly, we should have taken back a long time ago.
Asked what impact this could have on Canadian exports, Mark Carney said while a functioning Venezuela could eventually produce more oil, his government is working to expand domestic access to new overseas markets.
We welcome the prospect of greater prosperity in Venezuela, but we also see the competitiveness of Canadian oil, and we're investing, or we're putting in place measures so that that's going to happen.
Carney's remarks came after Conservative leader Pierre Poilievre called for him to rapidly approve a new West Coast pipeline. In a letter to the Prime Minister, Poilievre said every barrel the United States sources from Venezuela could mean one less barrel these refineries would buy from Canada. Though experts say it will take several years and major investments before Venezuela could outpace the 4.5 billion barrels of crude that Canada produces per day.
So while there's certainly potential to change the kind of medium to long-term oil market, it's still a less favorable place to do business in Canada.
Alberta Premier Danielle Smith says the events in Venezuela emphasize the need to reach new buyers with new pipelines, while BC Premier David Eby said he disagrees.
And that was CTV's Rachel Aiello. For more on the U.S. Venezuela oil and the impact on Canada, let's bring in Grace Wilton, a senior energy advisor at Enpro. And Grace, thanks very much for joining us.
Thank you for having me.
We've had a few days, I guess, to digest how things are unfolding. How is it shaping up? What kind of competition does it look like Venezuela will be for Canada? Do we have a clearer picture?
I think it'll be clearer in 2026 as the Memorandum of Understanding stipulates certain milestones have to be achieved, specifically a project proposal and approval by the federal government. Right now, there are many sides saying that there is opposition there, like your commentator just said, Premier Eby. But in the short term, we don't have competition. In the long term, there's definitely something to worry about, as the Venezuelan oil is the same type of crude as Canadian is providing currently to the United States. So yeah, there's a threat there for sure.
Could this be the impetus for, we're working, everybody says the pipeline's coming, the pipeline is coming. Could this be the final nail, though, I guess, if you want to call it that gets it going, or the final push that gets it going?
I think this is where the rubber meets the road for sure. If you can't get a more clear signal than oil companies being poised to invest, or having the track cleared for them to invest in Venezuela as security increases and their safety concerns are availed, right? It'll be in the next few years that they decide whether they want to invest in Venezuela, which I'm sure they do. Obviously, President Trump has given them the green light and all the encouragement that they need. All they need is that stability. So this should be very much motivation for the federal government, for Carney to use Bill C-5 and approve what he needs to approve as these proposals come before him. I think he has given the signal that is going to happen. I believe that that's what we will see. Yeah.
And if we do see the pipeline actually starting to come to fruition, would that be appealing to some of those companies, the oil companies, if they would look and go, look, everything's already in place in Canada. We have the know-how, we have the stability. Would that be more appealing than try to restart Venezuela?
Sure, for sure. I mean, if they have a green light from Canada, knowing that a project is pre-approved, then you've got security and stability that is underpinning those investment dollars from those companies. I'm sure that the United States will make it attractive for companies to go into Venezuela, because ultimately they want stability in that region too, right? But I don't think anybody wants anything less than stability for Venezuela, for their, for all the people that have fled that country to be able to go back and prosper. So I definitely think that as well as securing the stability of this hemisphere is a priority for the President of the United States. And I mean, he talks about bringing 50 million barrels of Venezuelan oil into the states. That's basically I believe what's happening right now. So that's the equivalent of about 150,000 barrels per day. And that is poised to ramp up and could be displaced by Canadian crude. However, I think that there's a fine balance, and I think that Carney is definitely motivated to approve what's necessary to bring Alberta oil to Tidewater.
And now there has been concern that there isn't a demand for it. Is this a case that if we build it, they will come?
I think that there is a demand for it. I mean, the type of heavy crude that we export is used primarily in construction industry. There are a lot of like asphalt and adhesives, what have you. There's definitely a lot of demand in Asia for that with the Belt and Road Initiative. Lots of activity there in order to use Canadian safe, secure crude and bitumen to be further refined and used downstream there.
And just one last question. OPEC is part of this, is part of all this. What kind of they've already said that they're going to pause oil output hikes. There's a bit of a glut on the market already as is. What kind of factors could those be on everybody's decisions on what they do with Venezuela or what they do in Canada?
Oh, I don't know. That might be a question for our chief petroleum analyst, Roger McKnight. But I think at this point in time, the Venezuelan situation is separate from the OPEC situation. This is very much a situation that was spawned by the need for safety and security in the region, for nefarious activities to be thwarted and stopped, and course reversal on those fronts. So I believe very much that the Venezuelan oil question is not something that the OPEC cartel is looking at right now. What I was reading on the weekend was they met on the Sunday, and they very much wanted to make decisions independent of Venezuela. So that's what I've heard.
Okay, we'll leave it at that. Grace, thank you very much for joining us.
Thank you very much for having me.
Grace Wilton is Senior Energy Advisor at Enpro. Coming up, Prime Minister Mark Carney is going to China. We'll discuss what it's all about right after the break. The Prime Minister's office has confirmed Mark Carney will make an official visit to China next week. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. The news just coming down today. A bit of a surprising. Seems like it caught a few people off guard.
Yeah, I think it did. I mean, the two leaders met back in October in South Korea at a summit. And at that time, Prime Minister Mark Carney did accept an invitation to go to China. So we knew that it was going to be coming. We didn't know when, but exactly. And now we know the date. So the Prime Minister going to China next week from Tuesday to Saturday. That's the 13th to the 17th. And Bloomberg is reporting that he will, in fact, be meeting with Chinese President Xi Jinping to talk about a number of different issues: trade, energy, agriculture, international security. This is the first official visit by a Canadian Prime Minister in almost a decade. Justin Trudeau was there last time in 2017. So it's been a while. And relations between the two countries, that's why it's been a while.
They haven't been the warmest.
They've been a little rusty. And so I think part of this will be Prime Minister Mark Carney obviously talking about how he wants to kind of repair relations, rely on U.S. a little bit more for trade. And this will be a big chunk of that, I think. Some of these relations span back to, if you remember that whole thing back in 2018 when Canada arrested Huawei executive Meng Wanzhou. And then in retaliation to that, China arrested or detained two Canadians, the two Michaels, Michael Kovrig and Michael Spavor, until Meng Wanzhou was released. East. So all of that really heightened these tensions between the two countries. And so it's going to be interesting to see how this plays out. And then also, like, there's the other factors here in terms of what this does to Canada's relationship with the U.S. Obviously, the U.S. and China have a bit of a rusty relationship, even with what's happening in Venezuela right now. Venezuela shipped most of its oil to China before what happened over the weekend. So there's a lot of geopolitical factors at play here that we're going to have to look into and see exactly how this is going to affect relationships Canada has with a number of different countries, just this meeting alone.
Yeah, and even politically in the country, too, for the Prime Minister. How will it play out? A lot of people are still wary of China and not sure. And if he comes back with some kind of a trade deal.
Yeah, so I think that's what we're going to be watching for, right? Because there have been increased tariffs from China on Canada and Canada to China over the last couple of months. But it's important to remember China is actually Canada's second largest trading partner. So it is a big
through
deal.
all this, we're still doing it.
Yeah. But I mean, right now, for example, Canada has import taxes on Chinese electric vehicles. That's a 100% levy. There's a 25% tariff on steel and aluminum coming in from China. And then in retaliation, China has implemented a 75.8% tariff on Canadian canola seed and a 100% tariff on canola oil, meal, and peas. And Canada is one of the world's largest exporters of canola, right? So that's hit Canada in the agriculture sector very hard over the last couple of months. And Prime Minister Mark Carney's been feeling the pressure on that. So we'll have to wait and see exactly what happens. We're trying to get more details in terms of what Canada needs to do, but it's going to be interesting to watch this meeting.
Oh, yeah, it's going to be fun. Can you imagine if you dropped the 100% tariff on EVs? Ooh.
Exactly. Things could change very quickly.
All right, we'll leave it there, Lindsay. Thank you.
Thanks.
BNN Bloomberg's Lindsay Biscaya. Well, all eyes are on U.S. President Donald Trump's foreign policy from Venezuela to Greenland to break down the latest in the developing Dawn Road Doctrine and its impact on the markets. We were joined earlier by Barry Schwartz, President and CIO of Baskin Wealth Management.
If you've been paying attention to what he's been saying since 2019, none of this stuff is new news, right? He's mentioned since 2019 that the U.S. should get Greenland. By the way, if you study history, this is not the first time the U.S. has talked about trying to buy Greenland or annex Greenland, but the Dutch obviously haven't acquiesced.
Danish.
Danish, yes. Sorry. So the bottom line is we have to take him now at his word, right? The tariffs, that was insane. Starting out with 80 or 90% tariffs, no one thought that was actually going to be going through, but it's happened. Venezuela has come true, and now next with Greenland and who knows, Canada and China, right? So, yeah, the U.S. is, I understand the U.S. standpoint. They're extremely worried about Russia and Chinese pressure and the mounting, military powers that those countries have and the closeness. And this is, as you said, the Dawn Road Doctrine, try and get the Western Hemisphere back into hands of the United States.
U.S. influence.
Yep.
And the interesting thing with Greenland, there are options where the U.S. could acquire Greenland. I mean, perfectly legal ways they could do it. It would take some voting. It would take some approval from Denmark and from Greenland itself, of course. Yeah. But there are ways that we could do it. But it also raises questions about Canada's north, because one of the big things is that Northwest Passage, and Canada maintains we own it. Yeah. And a lot of the rest of the world says, oh, no, that's an international waterway.
Well, if you look at the U.S. and say, well, what they're doing is crazy. Hello, you got other countries like China and Russia doing things that are also crazy and trying to protect their own people and whatever they're doing. So, this is the world we're in right now, right? There's always worries that China's going to invade and take over Taiwan again. We still have this Russia-Ukraine war going on. Russia's not backing down. So, the United States feels the world has gotten more dangerous and it needs to protect itself. So I can understand why it's doing it. Is it doing it in the right way? Who knows?
All right. And what about and Venezuela a little bit, the oil there? Is this as big a deal? It's a big deal, but is it as big a deal as some people are thinking it is?
It is a very, very big deal. Venezuela, obviously, we don't know 100% for sure if they have all the oil reserves.
Yeah, I think that's the big question. I was looking at some of the numbers.
So OPEC, of course, Venezuela is part of OPEC. OPEC is a self-reporting organization, so there's really no idea of how much reserves we have. Whereas in Canada, with the oil sands, Suncor, CNQ, Cenovus, these are all regulated companies. Their proven reserves have to be pretty good versus who knows what's going on with Venezuela. But it is a big deal, obviously. There's a significant amount of reserves there. Greenland, of course, there could be a ton of minerals, who knows? But, there's no infrastructure there. There's no railroads. There's no roads in the countryside. So good luck trying to build that out. I think it's probably more for strategic purposes than getting the minerals.
Out, but I imagine there is some value to it. I think in Venezuela also has been called mineral rich, but again, it may be the same situation, trying to access it. But we have that issue here in Canada,
well,
the Ring of Fire.
Listen, you have the players, Russia and China, getting closer relationships with the Latin and Central American countries, and this is not what the United States wants to protect its people.
Yeah, and especially, I mean, the Monroe Doctrine goes back, 100 years? late 1890s, that they were going to say, they told Europe, keep your hands off the Western Hemisphere, and it still stands out.
It's just, we woke up on January to a more dangerous world than we've ever had.
And so, where do you see this going with the oil, with oil companies within Venezuela?
Well, I don't know what's going to happen with Venezuela. Obviously,
there's a lot of
someone's got to go in there and take a look at the infrastructure. Can they really produce 3 billion barrels of oil? You know, is it 3 million or 3 million? 3 million barrels of oil per day. Is that really doable? Can they really ship all this stuff to the United States and have it refined? God only knows. Is the reserves actually there? Is it economic? With oil at $56, we know the Canadian oil sands are very profitable at $55 oil, make a ton of money. But they've spent so much money on technology and operations, and you've got some of the best operators in Canada operating the oil sands, whereas the United States, Venezuela, a lot of the oil sands has been sitting there.
And the reliability, too, with Canada, right? You know you're going to get your oil every day.
But the bottom line for us is we think CNQ and Suncor should be worth so much more because you have the flowing oil, you have the infrastructure, you have the technology, you have the security and the safety of those assets. I don't understand why the market knocked it down. To me, they should have been saying, holy smokes, if this is what the world really wants, they want oil. Hello, we've got some of the best companies, we've got tons of reserves. All we need is the infrastructure to start getting it to other countries, right? Then that's hopefully what the Canadian government will start doing.
And that's the other big question for it, right? Is this the impetus for the government to push on this, even with the pushback from David Eby in BC? Is this the impetus where they say, no, we're going through with this?
I sure should hope so, and I think hopefully that 2026 people have woken up to a different world.
Barry Schwartz is president and CIO of Baskin Wealth Management. Coming up, we're addressing the latest on the Toronto housing market. More on that after the break. Deloitte Canada is warning of tepid consumer spending as Canada's economy slows. A new report from the company's chief economist forecasts Canadian growth will slow to 1.5% this year. Don Desjardins notes two key trends to watch include trade and investment and Ottawa's plans to stimulate billions in investment from the private sector. Desjardins also notes the review of the Canada-US-Mexico trade agreement will be pivotal. That review is scheduled to start in July. British Columbia Premier David Eby says Canada should prioritize building more oil refinery capacity over new pipelines. The response comes after Alberta Premier Danielle Smith called to expedite new pipeline infrastructure to the BC coast. Eby says the existing Trans Mountain pipeline is not at full capacity and could be expanded further. The remarks come amid the threat that Venezuelan oil could begin to displace Canadian crude in U.S. refineries. Well, Warner Brothers says an amended takeover bid from Paramount is inferior to the deal it is working on with Netflix. The entertainment giant is urging its shareholders not to tender their shares to Paramount. Warner also saying the amount of debt financing and other terms put on it by Paramount heightens the risk of failure to close the deal. And a quick peek at the markets right now, and you can see the TSX. It's had a great start to the year, and today is going to be the day. You know there are going to be days like this. It's off by about 0.92%, but still above 32,000. South of the border, it is a mixed day down south of the border as well. The S&P 500 up barely, pretty much a wash. The Dow Jones hovering in record territory, but off by a third of a point, and the Nasdaq is up by 0.43%. Well, the Toronto housing market may be in a bit of a fixer-upper mode right now. At least that's the sentiment from the Toronto Regional Real Estate Board, who reported an 11.2% decline in home sales in 2025 over 2024. Joining us now to discuss these findings is Jason Mercer, Chief Information Officer for the Toronto Regional Real Estate Board. Jason, thanks very much for joining us.
Thanks for having me.
Yeah, the numbers concerning, and any indicators what's driving this right now?
I think it's an interesting story as we move into 2026, because on the one hand, we saw a real improvement in affordability as we moved through the previous year, where both borrowing costs and selling prices had trended lower, and that's across most major market segments. Yet at the same time, sales were off. In a normal year, you'd expect an improvement in affordability to see, an uptick in sales. But I think what we have on the other side of the coin is a lack of confidence with a lot of households, where they have every intention on purchasing a home at some point in the future. But they're looking at, you mentioned the trade relationship in your introduction, and also, roads that we may travel to mitigate that. But there's still some uncertainty. So I think there's a lot of households that are just sort of waiting to see what their economic fortunes look like, what their job situation looks like as we move through 2026.
Now, which area took the hardest hit, or has taken the hardest hit? Is it still condos?
It's been interesting. Like, certainly the condo apartment segment, has been driven by investment over time, and that's just by the very nature of how these buildings are constructed. It's a long time frame, so you have investors essentially acting like a wholesaler, so they're buying off of plans, looking to either sell or rent upon completion. And so, what we've seen over the last year is that the rental market has become better supplied, and so we've seen negotiating power on rents. So rents have trended lower, and so you have a decision to make as an investor. Are you going to take lower income, or are you going to list your units for sale? And we have seen more units listed for sale over the past year.
And I mean, that's the market for young people wanting to get in. Are they starting to take the bite at all, or are they, like everyone else, just kind of sitting and waiting to see what unfolds?
Yeah, I think certainly from a first-time buyer perspective, that could be a segment that drives recovery as we move through 2026. Obviously, they're very interest rate sensitive. They don't have the equity built up in multiple homes over time, and so they're really sort of considering that monthly payment as key. And so with affordability improved, if they're looking at, their employment situation and saying, I'm feeling more solid, maybe we see better news on the trade front or what have you as we move through 2026, that could definitely be a driver of growth.
And I mean, Toronto is a magnet for immigration. Is that playing a role as well, the reduction in immigration to Canada?
Yeah, I think that was an interesting story at the end of the year. And so if you look at the aggregate population numbers, we took a hit on the back of non-permanent migrants. And so, people that were, say, coming here for schooling or coming here from jobs, we haven't seen as many permit renewals as we've seen people leave. And that did impact the rental market with not enough demand for rental properties because people are only here for 1 or 2 years. Permanent migrants continue to flow into the country, and a lot of them focus on the GTA to take advantage of job opportunities, cultural diversity, and what have you. And a lot of those households will initially choose to rent, but then they'll make their way into the home ownership market over, say, 5 to 7 years.
And for younger people, is that what's happening? Is like, because there's more rentals available, are they taking a look and going, you know what, we can rent a place, we can find a new place for $500 a month cheaper? And why maybe not buy right now? Maybe just hold off.
Yeah, I think the calculus has changed for renter households. Are saying, look, I can negotiate a better deal either with my current landlord or on a different unit that widens that gap between the cost of renting and the cost of home ownership. So I think there's more time being taken, sort of considering that the cost right now in the short term versus building equity and what have you in ownership housing over the long term.
And we didn't really actually get into the numbers off the very top. How much are they down? What's the average price now? What are we looking at?
Yeah, I mean, if you're looking at the average price overall in 2025 compared to 2024, off by about 5%, and that's whether you're looking at the average price or the home price index. And again, that just gets back to inventory levels. I mean, if you look at sales being down and we're seeing growth in inventory really across the board, but especially in that condo segment, there's been a lot of choice out there for buyers, a lot of negotiating power, and so we saw prices trend lower. And I think that sets us up well for recovery as people start to move off the sidelines. They'll be able to take advantage of that higher inventory level.
And how, I don't know if you can talk to it or not. How is it comparing to other parts of the country?
Yeah, it's funny when you look at different segments. For example, like in Alberta, we've seen tighter market conditions. More demand for housing relative to inventory compared to places like Toronto and Vancouver. And so it is sort of a mixed bag across the country, just depending on how things have unfolded.
And then looking into this year, throughout the year, what's it? And in any indicators of a bounce back? And again, we were talking about this off air. It's a relative thing. If you're looking to buy, this is great. You want the numbers to go down. If you're looking to sell, though, it's not so good. But where any indicators which way it's going?
Yeah, 100%. I mean, we're going to be releasing our official forecast at the beginning of February. But I think, looking at it as a sort of a year or two halves makes a lot of sense. Like right now, the handoff from 2025 into 2026, not a lot has changed. We don't expect a lot of movement on borrowing costs. And I think there's still a degree of uncertainty out there. But I think if we start to see things solidify, whether we're talking about our trade relationships south of the border or some of these big infrastructure projects in Canada, getting off the ground and people can see the light at the end of the tunnel, then maybe we see more confidence and more movement into the market in the second half of this year.
And is it trade with the U.S.? Is that the biggest indicator or the biggest concern for people?
I think right now, if you're sitting in Southern Ontario, there's a lot of jobs that are in some way, connected to trade south of the border. And so I think a lot of people have their eye on that, topic, and then just broader sort of geopolitical issues and the volatility that can bring, I think has given some people pause as well.
Yeah, and we were hoping for a calm 2026. So far we're not seeing it. So we'll have to see what happens with it. But Jason, thank you very much for joining us.
You're very welcome.
Appreciate it. And Jason Mercer is Chief Information Officer for the Toronto Regional Real Estate Board. Coming up, a new report from Deloitte says 2026 is likely to mark an inflection point for the Canadian economy. We'll get more from their chief economist after the break. After a year of extreme uncertainty for Canadian trade, the country may be starting to turn a corner as the government enacts policies that aim to make Canada a more attractive environment for investment. For more on that, we were joined earlier by Don Desjardins, Chief Economist at Deloitte Canada.
Growth at about 1.5%, so a shade slower than in 2025 when it was 1.7. That's our estimate as well. I think what I'd say is that we think the first half will be slow. We're going to continue to operate under these extraordinarily uncertain conditions, but we do see reasons that we will see a strengthening in economic activity as we exit 2026 and head into 2027.
What are the brighter signs here?
Well, I think there's a few things. One is that although we're heading into the throes of it, we will have our review of the Canada-US-Mexico trade agreement. Now, our baseline assumption is that we maintain our carve-outs for our exports to go relatively tariff-free south of the border. We still maintain in the forecast some of these heavy tariffs we're seeing on those industries you mentioned earlier. So that takes a little bit of shine off that. But we think that as we go through the review, while the deal might not look exactly as it does today, it will in large part allow us access to our largest trading partner. Additionally, we do think that interest rates will remain relatively low. We have the policy rate holding at 2.25% throughout the course of this year. And I guess when we think about all of the policies that governments across this country are trying to put into place, we think by and large we will see enough on that side of the equation that it will restore business confidence and that businesses will start to put some money to work.
Politicians love cutting ribbons and talking about infrastructure spending, and that's the real core of the government's economic policy right now. They haven't gone for big tax cuts, as you know. Do you think they're on the right track?
Well, certainly when we think about what will instigate some investment by Canadian businesses. Sure, taxes, a big issue. But when we look at other things that are impeding their investment activity, we're seeing lots of red tape, as you say. So the elimination, or at least a significant reduction in some of those measures, I think will go some distance to helping businesses say, okay, we can get a return on our investment on a relatively good time. The other thing, as we know, is infrastructure. We need it. We need it to be improved so that our companies can get their goods to other markets outside of the U.S. timely and less costly.
Do you think there's a problem, though, that international business is going to be wary of Canada because of the trade threat? And also, I don't know if it's at the back of people's minds, President Trump's insulting remarks about Canadian sovereignty.
Well, I think if we're setting the stage to see investment and we start to see Canadian companies invest, that is going to show the world that, we are ready to build, we're ready to improve our productivity because we're willing to put our own money into our economy. And I think over time, and remember, none of this is going to happen quickly. We know that for sure. But if we start to see those pieces moving towards investment coming from Canadian companies, I do think that those opportunities will be seen by international investors as well. Again, we're not anticipating any huge, very rapid increase in investment. We do think it's going to take time. So as we exit this year and look to 2027, if we see some concrete improvement in some of these measures, that should, we think, be a catalyst for investment activity.
What about the labour market? Do you see much prospect, well, particularly for younger people who've had such trouble finding work?
Mm-hmm. Yeah, certainly when we're looking at the labor market right now, it is pretty soft. Companies are saying, sure, I may not be looking to reduce my workforce because we know population growth is slowing. We know that immigration is coming down significantly. But by the same token, not necessarily looking to add. So what's going to take to get them to really look at adding to the workforce? It will, in fact, I think, be this improvement in confidence, this sense that, yes, we're going to have access to the U.S. market. It's not going to be tariffed, and we will see demand for our goods continuing. So again, it's sort of a longer game. We're looking at the economy sort of in two halves, if you will. The first half is probably going to feel not that wonderful, but as we get through the review of the agreement, as we get to see some concrete results from government initiatives, we think these are the things that are going to turn sentiment, and we should start to see an improvement in the labor market conditions. But again, it's a bit of a time factor here.
And that was Dawn Desjardins, Chief Economist at Deloitte Canada. And coming up next, we will take a look at, hang on, Mike. A little magic wand just froze there. A New Brunswick cabinet manufacturer is finding new hope for keeping U.S. businesses. We'll have more after this. A New Brunswick cabinet manufacturer is hoping to maintain U.S. business relations after U.S. President Donald Trump announced tariff delays. CTV's Laura Brown with this report.
It was the last few hours of 2025 when kitchen cabinet manufacturer James McKenna received some unexpected but very welcome news.
We were extremely surprised, did not expect that it was happening, and greatly relieved. So first thing I did was got a hold of my U.S. customers, reached out to them and informed them of Trump's decision not to increase by 25%.
Upholstered furniture and finished wood products like cabinets and vanities were hit with a 25% tariff in October. U.S. President Donald Trump promised to increase it to 50% by January 1st. But in the 11th hour, Trump announced he would delay that move until 2027.
I think we can handle a 25% increase. Our U.S. customers are going to absorb half of it, and we're going to take half of it. At 50%, that would completely eliminate any chance of doing business with the U.S. And we've seen in December a drop off in sales already, a drastic drop off. Probably 50% of our sales in the U.S. have already gone away.
It definitely was a welcome relief, not a solution for us. As you mentioned earlier, we were hit October 1st with 25%, and in a manufacturing environment, that's very difficult to absorb.
There are no plans for layoffs at Glenwood Kitchens. James McKenna is hoping to find new markets this year and keep the ones he's already got in the States.
It's very difficult for us to plan our business. That's why As a company, we're actively looking at business outside of the U.S. to try and recoup the loss, to grow our business. And if the U.S. business does come, that means we're all the better.
Laura Brown, CTV News, Fredericton.
Well, market calls coming up next. And today on the show, we have Jamie Murray, president of the Murray Wealth Group. His focus, North American equities. And let's take a quick look at how the markets are shaping up. First up, we'll look at Bay Street right now. And after a solid start to the year, you can see it's a little bit, people taking some profits, but it's off 0.64. It's bounced back, actually. It was down nearly 1% at one point. One of the sectors to look at, though, right now is the energy and materials. Materials is up 4.3% for the year, but today it's off by about 2.2%, and you can see why. Silver company's taken a hit right now. Aya off by 5 3/4%. First Majestic off by 6%, and Endeavor off by 7.5% right now. Silver it's been extremely volatile. I was just looking at the most recent numbers. It's about $78, almost $79, but it has been bouncing back and forth after peaking at that record over 84 late last year. I say late last year, it was really only about a week ago. So that is how volatile the market has been. Now, south of the border, let's take a look and see what they're doing there. And you got the S&P 500. It's in the green, about 0.23%. Dow Jones off by 0.18. NASDAQ is off by 0.6. It's 6.6. And one to look at quickly before we go. Chevron's trading at about 156, around there. What are we at? 156.26, down slightly after that little surge in the news in Venezuela, but things have calmed back down. And that is it for Morning Markets. Thanks for joining us. We'll see you back here tomorrow.